Hey, everybody. Thank you all for joining me last night to talk about town interviews with Gabrielle Pierce. It was a lot of fun to talk about the Oakland mayoral election. But right now, we're taking an entirely different tack. First time I've had on anyone to talk about the subject of the economy in this way. My longtime friend Dan Kern of Cal, big game, parties and everything, but this is serious. So let me introduce Dan Kern. Daniel Kern is he's the chief investment officer at TFC Investment Financial Management, and he's been there since 2015. And in that role, he's responsible for overseeing TFC's investment process, research activities, and portfolio strategy. His author investment newsletters and white papers, or he authors investment newsletters and white papers, meets with select clients to provide investment support as well. Dan chairs the firm's investment committee, and then prior to joining TFC, Dan was the president and chief investment officer at Advisor Partners, a boutique asset manager in the San Francisco area that manages equities and asset allocation products for advisors, financial institutions, and family offices. He was responsible for management of the firm at that place, and including oversight of sales, client services, and operations. Dan's previous experience included managing director, portfolio manager role at Charles Schwab Investment, specifically Charles Schwab Investment Management, where he managed a $3.5 billion collection of mutual fund assets as head of asset allocation. And then prior to that engagement, Dan held a managing director principal role at Montgomery Asset Management, where he managed global and international equity portfolios. Before that, he was vice president he was a vice president at Wells Fargo, a CFA charterholder. Dan is a member of the CFA Institute and also is a certified financial planner. Otherwise, I probably should mention that first. And he's board member and chair of the Investment Committee for the Cambridge Community Foundation. He's on the board of advisors for the Brandeis International Business School, an independent trustee of the Green Century Funds, and on the board of directors of Wealthramp as well. Dan was a board member and president of the CFA Society of San Francisco, as well as board member of the Bay Area Financial Education Foundation. And it is my pleasure to welcome Dan in this capacity to talk about what's going on with our American economy and the world economy. Dan, welcome.
Thank you, Zenny. It's good to see you and good to be on the show. And I realize as you read off my biography that I've packed a fair amount into the last 3 decades or so. I'm a little tired thinking about it, but it's been a fun ride.
What, given your background, informs you about what's happening today? Because I read quite a bit of what you wrote and said, and you can give us some good advice, I think, regarding how to think about or how to engage with what seems to me the nuttiest period of my life.
Yeah, it's really been. I've been through an awful lot in my career, ranging from the Black Monday in the 80s, when the market had one really horrible day where it collapsed, to various crises outside of the U.S., the Mexico crisis, Asia crisis, the dot-com boom and bust, the global financial crisis. In a lot of ways, this I don't think is as serious from an economic or market perspective, but from a human perspective, this is more to deal with than I think we've had to deal with at any one time. It just feels like the accumulation of things that we are contending with is just much bigger, and it's all interrelated, and it's I think it's hard for people to take, and I don't blame people for seeing the news and wanting to run away from all of the headlines they see in the news. And for those of us who are investors, taking a look at your account statements and maybe not wanting to take a look at them. So I have a lot of sympathy, and there's a lot of information coming at all of us. And a big part of my job is trying to distinguish what I would call signal from noise. So sifting through all of the things that come my way, and I read different newspapers, publications, research reports. I talk to investment managers, economists, sometimes political officials. There's a lot of noise, and there are a lot of people that are talking their point of view, and it's emotionally and intellectually challenging, and I think magnified by the fact that no one ever sold a newspaper by saying, hey, nothing really bad happened in the world, nothing really good. We're just kind of moseying along and everything's okay. That doesn't sell newspapers. That doesn't draw people to cable network shows. And so there's, I think, more of a tendency for people to yell, hey, the sky is falling, or all of these stocks are going to the moon. And so it's I think, very difficult to sift through all of the noise and say, well, here's what we think is going on. So that's a long-winded way of sort of setting a baseline for us to talk about.
Yep.
And I think there is some good news, there's some bad news, and I think there's some things to be worried about.
Give it to us straight, no chaser.
Okay. Okay. So let's start with where we are from an economic perspective. So I think in the U.S. we have a Federal Reserve that realizes that they let inflation get away from them, and it's not all the Fed's fault. The Fed's in a tough spot. I think there was a lot of spending that came out of Washington. Some of it made sense. Some of it maybe didn't make sense. But the Fed waited too long to say, hey, maybe it's time for the party to wind down. Maybe we should raise interest rates. Maybe we should stop buying securities. They waited too long, and now they're in catch-up mode. And so they're raising rates. They'll likely raise rates by another 0.75% in early November. Maybe after that, they'll start to slow their pace down. But we definitely have a market reaction to us going from rates being zero not that long ago to now 2-year treasuries being above 4%. So the market's having trouble digesting that dramatic a move. At the same time, we have inflation, and I think inflation's going to come down, but inflation is brutal. We haven't seen, most people in your audience have not seen inflation at this level. I'm old enough to remember being a kid in the 70s and seeing inflation be very high, and seeing my stepfather talk about something called the misery index.
I remember.
And I go back to the days of when I was an emerging driver, a slowly emerging driver, the days of odd even gas days in California, where you had to wait maybe to get gas for your car. So most people aren't used to dealing with that, and so you've got high energy costs, high food costs, and of course those costs, they don't hit people like Zenny and I as hard as they do the lower income folks who get it from all sides. And so this is really a cost of living shock that many people are going through in an environment in which it's very difficult to begin with, especially if you live in an area like the Bay Area or Boston or New York, where living costs are extraordinarily high. So there's under the surface, there are people who are more or less equipped to contend with what's happening in the economy. So that's, I think, a second important point. We've got the Fed, we've got inflation, and then you have all this stuff going on outside of the U.S. And certainly Russia's invasion of Ukraine has created ripple effects for energy prices, but also this feeling that we had multiple decades after the fall of the Berlin Wall in which we benefited from the peace dividend. The peace dividend helped stock market valuations. It enabled many countries, including the US, to spend a little bit less on defense. The invasion of Ukraine is a wake-up call that it's a really dangerous world out there. And so there is a risk of some really bad things happening, but also the need for countries around the world to spend more on defense. That's another, there are winners and losers in the stock market that will come from that, but that's definitely a big change for stock market valuations, and also a big change for how governments are going to have to spend money. So that's a third really big thing. And we've gone through three big things, and we haven't mentioned the after effect, the hangover from COVID. And although it's great, I've had needles stuck in my arm more often over the last few years than I ever would have expected. I got my bivalent booster this week alongside getting a flu shot. And that's great for most people and protects most people from the risks of COVID. But there are a lot of people who have left the workforce because they're either suffering from long COVID, they're caring for somebody who has COVID, the vaccines aren't available to them because they've got other existing conditions that make the vaccines a bad idea. So we've had this permanent, I think, departures from the workforce, particularly among people 55 years old and over, and that has an impact on the labor markets and labor market tightness. There's 1.7 jobs open for every worker seeking a job. And so that's creating a lot of cost pressures for companies, and creating a Fed that's worried about a wage price spiral that would make inflation a more persistent problem for the economy. So that's a lot of bad stuff in a few minutes, and I haven't even talked about what's happening in China and tensions between the U.S. and China. So that's all the bad news. I think there are silver linings here, and so why don't I turn from the bad to the at least less bad, if not good. And on the good side, I think, is that markets have really adjusted. We've got U.S. equities down 20% for the year. I wouldn't call U.S. equities cheap, but they're certainly a better value than was the case when we started the year. Equities outside of the U.S. Have declined even more, in part because the dollar has been so strong. So I think there are buying opportunities in the stock market. On the bond side, those of us with some cash sitting in the bank or in a money market fund, we weren't getting a lot of return on that cash now, and now you can go in and get a much more attractive return with government bonds yielding more than 4%, and corporate bonds and mortgages yielding even more than that. They are starting to get a little bit more value in the bond market. So I think that's that's good news. I do think that the Fed will have some success, and the natural force of gravity, I think, will help bring inflation down. I think the Fed may be embracing some magical thinking in saying that they can get inflation down from 8% to 2%. But I think they may declare victory if they can get inflation down to a level that starts with a 3. And I don't think the world would come to an end. There's really nothing magical about 2% inflation. I think the world in many ways would be just fine if inflation was 3%. So I think there's a little bit of a silver lining there. And then lastly, from a top-down view, there's what I would call recency bias in investors' minds and in people's minds, which is whenever there's discussion about recession, the reflexive reaction is, oh, this is going to be like the global financial crisis, or it's going to be like the first weeks of COVID, or for the elderly among us who remember how bad the stock market was in the 70s, it's going to be like that. And I don't think this has been a really rough year, but consumers have a lot of money in the bank. There's a lot of savings, and it's only really the lowest income consumers that have started to meaningfully draw down their savings. So I think that's great. That helps. People have a cushion. Most people have a cushion. People are also way less indebted than they were. I think about the global financial crisis and how much debt people have and how much they were paying in interest payments on that debt. And it's dramatically lower this time around. The same thing, I think, with banks. When you look at banks, banks were really in a fragile state in the US in 2007, 2008. That's not the case today. And the real estate market, even though for those of us with roots in the Bay Area home prices are still ridiculous. I wish I still owned a house in the Bay Area, but I think about all of the problems there were. There'd been overbuilding for years in 2007. People had adjustable rate mortgages, and when interest rates went up, they had this payment shock. There were a lot of things that were wrong in the housing market. The contrast today is banks have found religion because the regulators have forced that issue. So the loan quality is much higher. Rates, 90% of U.S. mortgages are fixed rate mortgages. So you don't have the rate shock to worry about. And we've had a decade of underbuilding. So I don't think the calamity is ahead of us.
I'm here in Fayette County, Georgia, and the home prices here have just shot up like nobody's business. Their homes here going for $500,000 that normally went for $300,000. And just add to what you're saying there.
I think you'll start to see that taper off. But how much of that is people saying, now that I can work from home, I don't have to be within a half-hour radius of a downtown area, or I can leave the Bay Area altogether and telecommute and have 3,000 square feet and have good schools. And I see a lot of migration to places where you can spread your elbows out a little bit.
And that's it. Do you realize that all the Marvel Avenger movies are made just 15 minutes from where we live here in Fayette County, Georgia?
I didn't know that, but that makes sense.
Yep.
It's probably 20% the cost to make those movies there than it would be in California or Boston or New York.
The California movie industry has dumped itself in Georgia.
Yeah,
it's crazy, man.
It's just amazing.
Add what you're saying.
So I think that despite a lot of really bad news that's out there, I think now is a pretty good time to be investing money. There's a lot of things that can still go wrong from here. So when our clients come to me and say, I've got some cash, should I put it in the market? My response is normally, yeah, but do it slowly, because we still have a lot of unknowns in between Russia and Ukraine. We've got unknowns with China. We've got a midterm election coming up. There are things we don't know how far the Federal Reserve will go in overreacting, or whether they will underreact. So there's a lot of things I think still in play, but I think it's a good time to start judiciously investing in the market.
A question on that too, as we it's at the 4:22 mark, and I know you have to stop at 4:30, but I'll check in with you. I'm really curious, Dan. I'm getting a crap ton of emails that are telling me from market watchers to invest in coal. Now I'm scrolling my money, but coal. I'm thinking, well, I thought that I'm hearing EV. I've got all these commercials, and then these are not activists, they're not wild-haired people. These are right. They're market watchers, and it's just saying it's Russia. What's going on?
It's really interesting, and so I'll admit that I've shied away historically from businesses that the government wants to either regulate or legislate out of business. And so I haven't been historically a big tobacco investor. It's clear that the Biden administration has wanted to put coal out of business. But if you look at some of the big U.S. coal stocks, they're some of the best performers in the market. And I think the tobacco analogy is a good one. I think to some degree the market is saying, because of the need for energy security, coal's likely to be around longer than our models projected a couple of years ago. And so companies like Arch Coal are up. Arch, I think, is up 47% this year. So there are some big winners among coal companies, and I get it. I still have a general discomfort, but I think it's fair to say that there may be a longer life to coal. As a board member of an environmentally focused mutual fund family, I think they would probably throw me out of the room if I started to advocate investing in coal stocks. I would say, though, that I think in general resources, whether it's legacy energy resources or climate change focused resources, I think will be an interesting place to invest in the coming years, because I think there'll be a longer tail for traditional energy, and I think the demise of traditional oil companies may be greatly exaggerated, but at the same time, there's going to be a lot of spending on the climate transition, and there will be a lot of, I think, uneconomical companies that don't do well in the transition. So I would urge selectivity, but I think there are opportunities in the new and in the old energy sphere. And I think the events of the last 6 months, 8 months from the invasion of Ukraine, I think tell you that energy is going to be a place where there's a lot going on, and there will be a lot more focus on energy security. I think it's going to be interesting. And I think if we have a winter where there are rolling blackouts in some of the states that have gone more aggressively into decommissioning traditional energy and moving to intermittent sources of energy, I think you'll see even more of a wake-up call on the importance of energy security and energy continuity.
A curious wild-haired question, not so wild-haired. Are you factoring in your thought, like not officially, but just in your thinking, what would happen if Russia dropped a nuke?
Yeah, unfortunately, it's something that we've had to talk to current and former government officials and intelligence services employees, former and more former because the current ones won't talk to us, about the I think more optimistic people say that Putin is not likely to drop a tactical nuke on the battlefield because you can't really control the impact on your own troops, and depending on how the winds blow, that what will come into Russian territory. There is also some question about whether Russia's generals, many of whom have died during this conflict, whether they would actually take action if told to. But with that said, some people I respect have talked about the possibility of him trying to take out Zelensky preemptively using a nuke. I don't think that's a likely scenario, but it's not so unlikely as to be an impossibility, and that makes me. I'm sitting here under the table like pushing on my finger because I've got that reflexive oh that's. I'd like to say there's a 0 chance of that, and I can't say that, and it makes me uncomfortable. I do think the odds are against that, and I think that I don't think we would respond in a nuclear way, but that we've got a lot of capabilities. The U.S. has a lot of capabilities that we would employ against Putin. I also think that it would completely solidify all of the NATO members against Russia. I think the more likely scenario is that Putin tries to wait out the West over what may be a long, cold winter in Europe, and in hopes that the Western resolve on sanctions and support of Ukrainian people that softens over time. And I think that's the more likely. To me, that's the more pragmatic scenario for somebody like him. But pragmatic and Putin don't always go together, so we'll see what happens. I'm looking at the clock. I think I've got 10 more minutes.
Okay, cool. Color Me Oakland. Hey, Color Me Oakland, thanks for coming by. He asks, what role can investors play in shifting the economy toward true healthier sources of energy, and what are best investments in that area? Thanks.
Yeah. So thank you, Color Me Oakland. So I think putting your money and aligning it with your heart and investing in clean energy. There are investments directly in clean energy production, but also in enabling technologies. We work with managers who invest in companies like Vestas Wind Systems, which manufactures wind turbines. There's battery technology opportunities that are emerging but interesting. I will say that some of the interesting opportunities are outside of the U.S., but there is money to be made. I would caution that these are long-term investments, and some of them, there's a lot of stories. So I would do your homework before investing, because there are a lot of what I would call exploratory stage companies that may not have what it takes. I would look for a clear path to being cash flow positive and profitable, rather than investing too much in science projects.
Your talk reminds me that I cover CES every year. Have you ever been to CES? And maybe people should pay attention to that, because
there's some really interesting things that happen in CES. Our mutual good friend Greg Haywood used to go to CES every year, and I used to always find it interesting to talk to him afterwards about what kind of cool things that he was looking at there. So yeah, that's a great idea.
I actually ran into him at the Chandelier Lounge 4 years ago. But yeah, you're absolutely right. And I say that, folks, it's a good way to march that. Oh, before we close too, there's something else that's concerning me I want your feedback on, and that's what's called the labor force participation rate. And I happened to look at the data, and to make a long story short, if you take out the two highest rate states in the United States, only 1 out of every 2 adults is in the labor force. In other words, the participation rate is 50%.
Yeah.
And can we really trust the employment figures that we're getting if half of our workforce isn't trackable anymore?
I think there are some measurement problems with the workforce because of the rising number of gig workers, or, whether it's Uber drivers or delivery service workers. There's a lot more that's shifted out of, at least what I would put in quotation marks, the formal workforce. And so I think there are some measurement issues there. I do worry about the number. We'd had a rising trend for many years of older workers, and I really dislike the phrase prime age workers. As somebody whose age starts with a 6, I still think I'm pretty much in the prime of life, and with life expectancies, generally going up. I plan on staying in the workforce for a while longer. But we are seeing after years of the 55 plus cohort staying in the workforce longer, maybe changing the nature of how they work. We've seen that really roll over because of COVID, and I don't see the natural replacements. We've really shut immigration down, and so we've closed that off. We've got people out of the workforce because of COVID. We have Gen Z as a much smaller cohort of entering workers than millennials. And so I feel like we've got a little bit of a hole in the workforce that is going to be hard to fill, at the same time as I think there have been some perverse incentives that motivate people to be out of the workforce. And it would really be nice if we had a government, whether it's Republican or Democrat or a combination of both, that actually thought about incentives and thought about what's it take to get people in the workforce, what does it take to keep people in the workforce, how do we train them. I feel like those are discussions that are had on the campaign trail, but there's limited follow through, and it's frustrating to watch.
As much as I want to eke out time with you, let me bring you to a nice soft landing. How do people contact you for more information and engagement on what you do?
Our website is www.tfcfinancial.com. My social, what I'm most frequently on social is LinkedIn. So you can find me on LinkedIn, and my email address is dkern, Kern, @tfcfinancial.com.
Yeah, let me put that down for the email again. One more time, Dan.
Sure. dkern.
Kern. D by heart.
At tfcfinancial.com.
Financial.com. There we go. There he goes, folks. And I gotta before I let you out of here, the Golden Bears. What do you think?
One of the few benefits, my wife Darlene and I moved from the Bay Area to my adopted home and her longtime home of Boston 9 years ago. And one of the good things about leaving the Bay Area is I don't have the weekly pain of going to the Cal games. And oftentimes when it's a 7:30 kickoff on the West Coast, it's 10:30 on the East Coast. I'm too old to stay up that late, so I'm not. That's a rare occasion. I did go to South Bend to watch Cal play Notre Dame, and I thought we were going to win that game. And it was a long bus trip back to Chicago after that game. It's painful. It's really painful. We've been through I don't know how many coaches, and I feel like I love Oakland. I miss Oakland. I miss being on the Berkeley campus. There's a lot that I miss, but I'm avoiding a lot of pain. I put my phone on mute on Saturday nights when it's a late game, because I wake up in the morning to a group text chain of maybe 300 texts on average from people generally demonstrating high degrees of anguish. So I'm not really missing that. When Cal gets good again, I will miss being as much a part of it. I will say though that what I really miss is the Golden State Warriors and watching Steph Curry and Klay Thompson. I miss them. That's a different. As much as I like my hometown Boston Celtics, I so miss watching the joy of the Golden State Warriors basketball experience. So that's been a hard adjustment to see them be so good and to not be there and in order to witness it in person.
Yeah, I'm my friend. I'm right there with you, Dan. We gotta have you back, man. It's a lot of fun.
Anytime, Zenny. It's so good to see you, and I look forward to seeing you in a few weeks, I hope.
Yeah, I hope so. Touch and go. But hey, stick around in the background, folks.
Okay.
Man. And folks, subscribe to Zenny62, bookmark Oakland News Now, blog.com, and we'll see you later tonight at 8 o'clock. Blockbuster interview. Whistleblower wants to blow the whistle on Shang Tao, who's running for mayor. Work for her. 8 o'clock Pacific, 11 o'clock Eastern. Stick around, Dan. Thank you, everybody. That ends this broadcast.